another exciting episode of What I Think Media. So, in this particular video, I'll be talking about sell call. In my subsequent videos, I talked about sell call before, but I didn't do the practical. So today I'll be going in details demonstrating what sell call is all about, and I'll be using Robinhood as my brokerage company. Okay, so if you watch the video on sell put, now this is another way you can also make money if eventually your order or your contract went through when you were doing your sell put, because this is how it works. Let's say in the sell put you had a contract or one contract which is 100 shares of a particular company, and that's 100 shares. You selected a particular strike price and you got paid your premium. You were excited and you picked the expiration date. Now the price of that company fell below or to that particular strike price you picked, and now you've automatically bought 100 shares. And maybe it's a company you really wanted to keep the stock. For another reason, it might just be you wanted to collect the premium, but right now you now have the 100 shares in your hand. What do you do? Do you keep it or do you sell it? And how can you sell it and keep making money? Or what can you do with it to make more money? This is what I'm going to be teaching you today in the sell call. So if you've not subscribed, please make sure you subscribe and comment, share, so that you can get the first-hand information as I drop them. Okay, make sure you subscribe. Don't just watch this video without subscribing. Make sure you subscribe. All right, so now let's go in details. So let me launch into my Robinhood app. Okay. All right, so I'm in my Robinhood app right now. So like in my previous example, I used Apple, so I'll be using Apple again to do the sell call. Okay, so first thing first, let me search for Apple. I don't have it on my watch list, so that's why I'm searching for it. But if you've done your market research and you have stocks on your watch list that you're really interested in, you can also, use it if they are companies. But my advice to you is that make sure the company you are trading options on are companies you really want to own their stock, just in case the contract is executed. Okay, so make sure it's a company that you're really interested in owning their stock, so that when you have the 100 shares, you don't become worthless in your hands. All right, okay, so that's out of the way. So search for Apple. Okay, so right now Apple is down. Apple is down 1%. But let's say the option for sell put went through after you collected your premium, the contract was executed, you now have 100 shares of Apple, which maybe you bought at the strike price of 134 or less. So what do you do in order to make money with that same 100 shares you have? This is where the sell call comes in. So you go into trade options. So you select an expiration date. So on top of this Apple store, we can see we have different dates. We have the February 19th, we have February 26th, we have March 5th, we have March 12th, we have March 19th. So let's say you want to trade option call, or sorry, you want to trade sell call. What do? You pick a particular expiration date, let's say February 19th. Then you select sell, then you select call. So like last time, since sell call is different from sell put, the strike price is going to be above the current market price. Okay, for the sell put, the strike price is below the current market price. We see the share price, like this power says shares 132.91, you will see that this is the current market price. Below it is the other prices which we are not going to deal on, since we are not dealing on put, we're dealing on call. So if we're doing put, we would have selected the price below this share price, but since we are dealing on call, we select price above, because call means that the price is going to appreciate. In other words, it's going to increase in value. So right now, let's say we want to trade call for let's say 134, one contract. So if we're going to do a sell call for one contract for February 19th, the premium we are going to get will be $98. $98. That's the premium we are going to get, $98. So like I said in the previous video, this premium is non-refundable. It's not refundable. You already have the shares, which makes this even more interesting. You already have 100 shares of Apple. Okay, so right now, if you execute this contract, you get paid $97 right away. That you can do whatever you want to do with that money. That money is yours. But the issue is that now that you've been paid premium and the contract and the option has been initiated, if Apple increase to 134, you have no option but to sell 100 shares for that particular price. Okay, so just like put when the strike price is hit, you have to buy. But for the call, when the strike price is hit, which is in this case 134, you have to sell. Okay, so you have to sell every shares you have, which is the 100 shares, one contract. Everything has to go. Okay, so that's how the sell call works. I believe I've been able to explain this, but if you're still trying to understand what this is all about, you can always rewatch this video so I get a proper understanding of what it is. It is easy, but the only difference is that for put, you need a collateral, which is the amount of the strike price, the equivalent of the strike price you are selecting for 100 shares. So if it was 134 strike price you selected for put, you need to have $13,400 in your trading account that Robinhood is going to hold on their own account, that in case the price falls to 134, then they have to buy the 100 shares for you. Okay, but if it doesn't, then you get your money back, all within the expiration time. But in this case, if it happens that the price appreciates to 134 for the call, which you already have 100 shares, but right now you pick the particular strike price, which is 134, and an expiration of February 19th. So if the price appreciates to 134, you have to sell everything. You have to sell everything, which is the total of 100 shares minus the fact that you've already gotten your premium. Okay, so that's how it works. You get paid your premium irrespective of whether the stock price drop or goes up. The premium is for you. So the other beautiful thing is that maybe you might have entered this option at a lesser price. Maybe you got into the puts at maybe 132. So maybe you got the 100 shares for $132, and now the price you are anticipating is 134. If you eventually get to 134, you've made money. So your stocks have appreciated, you've made money, and also you also made premium. So that's double win. But if eventually it gets to 134 and you sell, you've made profit, you didn't lose. So you got profit from the appreciation of the stock, and also you got profit from the premium that was paid to you. So I don't know if that was clear enough. So it's a win-win. It appreciates to the particular price you picked, you get the difference of the appreciation, and you also got your premium. So you are making money both ways. But the key factor is that get into option of a particular stock you know or you believe is credible and has the potentials to either increase in value or has good fundamentals as a company, and you are rest assured that this company is not going to, waste your money or make your contract worthless. All right, so these are the two safe ways you can trade options or trade stock in general without losing money. That's if you are afraid of stock trading. But if you are not, then you can go into the buying, which is regular buying of the shares. But another thing you must also understand, there's more profit in the buy, but that's more risky because your money is what you are putting forward. So if it doesn't hit the way you anticipate, you can lose everything. All right, okay. So like this one, which is the date, the expiration date selected was February 29, February 19. So the further you go, let's say March 12, you can see that the same 134 one contract, you get $358. If you already have the 100 shares, you are paid a premium of $358 instantly. But now if the price appreciates to 134, you have to sell. So the appreciation you get from the shares and the premium, those are also win-win. So in this case, it's a win-win. So that I just can't stress that enough. It's a win-win. So you have nothing to worry about. Okay. So if this video has been helpful, like, share, comment, and don't forget to subscribe. So I'll be coming with subsequent topics about the various investments that you can make for retirement. Sometimes we work and work and work and we forget that sometimes we are not going to be able to work again, and that's where the real reality sets in. But if you want to still be able to live a good life after you retire, there are ways you can set it up without you even knowing. Okay, I'm going to teach you a formula that you can use to strategize your future and make a very, very robust retirement. So stay tuned. In the next video, you'll be getting all those information. So don't forget to like, share, subscribe. See you in the next video. Have a wonderful day. Bye.